So the financial position of Delaney Ltd on the 1st of the 1st 2016 is shown in the following balance sheet, which you have there on the left hand side. The following transactions took place during 2016. So January, Delaney Ltd decided to revalue land and buildings on the 1st of the 1st 2016 at €800,000. The land element of this new value is €110,000. So I would underline the land element of this new value is €110,000 and draw it down to December. So just draw an arrow there, leading down there, because whenever we're doing the buildings depreciation, we want to remember that there is land incorporated in that 800,000 of 110,000. So February, Delaney Ltd bought an adjoining business on the 1st of the 2nd 2016, which included buildings 180,000, equipment 50,000, debtors 12,000 and creditors 20,000. The purchase price was discharged by granting the seller 200,000 shares in Delaney Ltd at a premium of 20 cents per share. In March, management decided that the provision for bad debts should be increased to 6% of debtors at the end of March. In April, purchased goods on credit for $14,760. This included VAT of 23%. In June, received a bank statement on June the 30th showing a credit transfer received of $7,200 to cover 8 months' rent received in advance from June the 1st and a direct debit of $4,800 to cover security costs for the year ended 30th of the 4th 2016. In July, paid by cheque a creditor account balance of $1,800 and received a discount of €100. In August, a payment of €900 was received from J. Barry, a debtor whose debt had been previously written off. This represents 80% of the original debt, and Barry has undertaken to pay the remainder of the debt. On the same day, goods to the value of €369 were sold on credit to Barry. This includes 23% VAT and a markup on cost of 20%. September, received €50,000 from the issue of the remaining shares. October, goods previously sold for €738 by Delaney Ltd were returned. This figure includes VAT at 23% and a markup on cost of 20%. Delaney Ltd issued a credit note for €700 due to a delay in returning these goods. November, a creditor who was owed €4,000 by Delaney Ltd accepted equipment, the book value of which was $3,200 in full settlement of the debt. The equipment cost €5,400. December, the building's depreciation charge for the year is 2% of book value. The depreciation charge is to be calculated from the date of valuation and date of purchase. The total depreciation charge on vehicles for the year is €8,000. Required. Record on a tabular statement the effect each of the above transactions had on the relevant asset and liabilities and ascertain the total assets and liabilities on the 31st of the 12th 2016. So this is what the completed tabular statement is going to look like, and you have this template in the exam in which to do it. So step 1 is to lay out the tabular statement. So what we do, we list out all of the assets on the top here, and we list out all of the liabilities on the bottom half of the page there. We take the figures across. So land and buildings, €630,000 here. We've got depreciation, 25,000 minus here. We've got vehicles, 50,000 here. We've got minus 27,000 depreciation. We've got equipment, 15,000, and then we've got minus 3,000 depreciation of equipment. Then we have stock, 73,000, and then we have debtors. So 86,400 is 96% of debtors. So if we work out what 100% is, that is debtors, 90,000 debtors, and then bad debts provision is €3,600 there. So in total we've got 799,400. Then we list out all of our liabilities. So we've got share capital 560,000, we've got share premium 30,000, we've got P&L balance 109,000, and then you've got 54,000 creditors, 32,000 bank, 8,400 VAT, and then 6,000 expenses due. Now it doesn't matter what layout you do them in, as long as they're all in there. So let's get started then with January. So in January, Delaney Ltd decided to revalue land and buildings on the 1st of the 1st, 2016 at €800,000. The land element of this new value is 110. Now I did ask you already to underline the land element is 110,000 and draw that line down to December for when you're doing your depreciation. So they're going to be revalued up to 800,000. So 630,000 up as far as 800,000 is 170,000 to be added to land and buildings there. So 630 plus 170 is 800,000. So we have the minus 25,000 here in the depreciation for the buildings. We are going to add that back in as well. So if we revalue buildings, we need to unwind any depreciation that has ever been charged on them. So that in total is €195,000 there. So we have to add a revaluation reserve, 195,000 down in the liabilities. So if you imagine your question 1, you would write in your finance by section of your balance sheet, which is all liabilities, revaluation reserve. So it's the exact same thing there. So 195,000 down to your liabilities. So you've got 195 and 195. So February then, Delaney Ltd bought an adjoining business on the 1st of the 1st, 2016, which included buildings €180,000, equipment €50,000, debtors €12,000 and creditors €20,000. The purchase price was discharged by granting the seller 200,000 shares in Delaney Ltd at a premium of 20 cents per share. So in February here we've got our 180,000 into our buildings, we've got our equipment 50,000 and we have 12,000 into debtors, and then we have creditors 20,000 here. The purchase price was discharged by granting the seller 200,000 shares in Delaney Ltd, which is here, so 200,000 goes here, at a premium of 20 cents per share. So 200,000 multiplied by 20 cents is €40,000 there. Now, at this point in time, our assets and liabilities do not equal. So our assets currently are sitting at 242,000, so 180 plus 50 plus 12 is 242. And all of our liabilities is 260. Now we know we need to have 260 and 260, so therefore we have to add something into our assets. We are going to add 18,000 into goodwill, which is in our assets, so 18,000 there. Now, what is goodwill? It's the established reputation of a business when it's being purchased there. So Delaney Ltd bought a business and they have a really good reputation, lots of customers, etc. So it is an intangible fixed asset. So goodwill, 18,000 there. Now, March then. Management decided that the provision for bad debts should be increased to 6% of debtors at the end of March. So what do we need to do here? We have debtors 90,000 and 12,000, which is 102,000. So 102,000 multiplied by 6% is equal to 6,120 bad debts provision. So what am I going to do then? Bad debts provision was currently standing at 3,600. I need to make that to be 6,120. So therefore, I need to take away a further 2,520 to make this 6,120 minus. Okay, so I'm going to minus another 2,520. So that is an increase in bad debts provision. So my bad debts provision has gone from 3,600 up to 6,120. So that is an increase in bad debts provision. An increase in bad debts provision is going to reduce my profit figure. So therefore, I'm going to minus 2,520 euro there. So minus 2,520 and minus 2,520 here. So that's March. Then April, purchase goods on credit for 14,760. This included VAT of 23%. So what am I going to do here? Well, we've got VAT in this question. So we're going to have stock. We're going to increase our stock. We're going to increase our creditors, because we've purchased goods on credit from them. And then we're going to enter VAT into the VAT account. So stock, first of all, how much is the stock? So what is the cost price of the stock? So if 14,760 divided by 1 through 3 multiplied by 100, it cost us 12,000. It cost Delaney Ltd 12,000 to buy that stock. So up in the stock, in the assets, we're going to add 12,000 up there. Then in the liabilities, we are going to add the cost price and the VAT to creditors. So we have to pay the creditors the amount including the VAT, so the 14,760. And then in the VAT, okay, we are going to minus 2,760. So the VAT is 2,760. So 12,000 is the actual cost price, and then the VAT is 2,760. Now, how do I know whether to plus or minus the 2,760? Well, if you minus it, you know you're going to have 12 here and 12 here. But how do I know? Well, when I purchase goods, so if everybody wants to draw out a T account beside them, I have purchases and I debit the purchases account. Now, the VAT attached to those purchases is also going to be debited. So I put it on the same side. I put the VAT, record the VAT on the same side as the item that it is attached to. So as you guys know, double entry rules, purchases is debited. So therefore, we're going to debit the VAT that is attached to that. Now, how do I know to minus it though? Well, in my balance sheet, my VAT was in my current liabilities. So I know that the VAT there was credited. So if I'm going to debit VAT, I'm going to minus it. So it's on the other side. So minus 2,760. So you've got 12,000 then in both assets and liabilities. So then we've got June. So received a bank statement on June the 30th showing a credit transfer received of 7,200 to cover 8 months rent received in advance from June the 1st and a direct debit of 4,800 to cover security costs for the year ended 30th of the 4th, 2016. So what do we do? First of all, we're going to enter the figures into the bank. So received a bank statement on June the 30th showing a credit transfer received, so that was money received into the bank, so therefore the bank overdraft is going to be reduced, so we minus 7,200 there. And a direct debit of 4,800 to cover security costs, so that is money going out of the bank, so that is an expense, money going out, so that is going to increase my bank overdraft there. Now I'm going to have a think about where do these items go. So if I had 7,200 to cover 8 months rent received in advance, so that is from June the 1st. So that is going to be rent receivable for June, July, August, September, October, November and December. So that is 7 months rent receivable for this current year, which is 2016. So at the end of the year, we're going to have 1 month rent receivable prepaid, and that is a liability. So therefore, I'm going to write down here rent receivable, and I'm going to throw the 7,200 in here. Now, the next part is where am I going to put the direct debit of 4,800 to cover security, that's expenses, costs, for the year ended 30th of the 4th, 2016. So that is during 2016 then it was for 4 months. So there was 8 months expenses due then at the start of the year. So that relates to expenses due. So in this 6,000 there was 8 months security expenses there included in this. So that is going to go into my expenses due. So I'm going to minus 4,800 from this 6,000 expenses that were due because it relates to that and it's reducing the amount that is owed. So you can see if you've got all 4 figures in one section, we're going to have 0 and 0. So just whatever you do with your bank, you're just going to do the opposite to the other. Now, as you know then, what we're going to do now is we're going to do the December column. So as you know, you've got your bank column whenever you receive your bank statement, and then you have to do a December column for the expenses or revenues, prepaid, whatever you might have then at the end of the year. So this is the bank column in December. So what we do here is we say, well, what was attributable to the current year, which was 2016. Okay, so let's think about the rent receivable first. So as I said, it was 7 months relates to this year, 2016, and 1 month relates to next year. So you have 1 month rent receivable prepaid at the end of the year. So 7,200 multiplied by 7 divided by 8 is 6,300. Sorry, that should say 300. So we minus 6,300 from the rent receivable here. So here it had said 7,200 and we're minusing 6,300. So we're going to have 1 month rent receivable at the end of the year. Now, what else are we going to do with this 6,300? Well, 6,300 rent receivable, what is that going to do to my profit figure for the year? Well, that is going to increase my profit figure for the year, isn't it? So I'm going to put 6,300 into my P&L then for the year. Then looking at the expenses. So the expenses, I had 4,800 put into the June column, but that was for security costs up to the 30th of the 4th, 2016. So 4 months were for the current year, 2016. So at the start of the year, they had 8 months due those expenses. So they were 8 months behind there. So what we have to do is multiply 4,800 by the 4 over 12 to find out that 1,600 euro of that related to 2016. So therefore 1,600, so I'm going to have 6,000, right, minus 4,800 here, plus 1,600 there, and that is equal to 2,800 euro. So 1,600 expenses for the year. What is that going to do to my profit figure? That is going to decrease my profit figure as expenses and money coming out. So decrease my profit figure here, minus 1,600 there. So that is your June adjustment completely done there. So moving on then to July, paid by check a creditor account balance of 1,800 and received a discount of 100 euro. Okay, so the creditor account balance was 1,800, so that's how much we owed the creditor. So the creditor is going to reduce by 1,800. Okay, we received a discount. What does discount do to our profit and loss figure? It increases our profit and loss figure. So discount received in add operating income increases our profit figure, so plus 100 in there. And then how much was the cheque for? Well, the cheque must have been for 1,700 euro there, okay, because they got a discount of 100 and the account balance was 1,800, so therefore the cheque was 1,700. That is going to be added to the bank overdraft because the bank's already in minus. More money coming out is further into overdraft. Okay, August then. A payment of 900 euro was received from J. Barry, a debtor whose debt had previously been written off. This represents 60% of the original debt, and Barry has undertaken to pay the remainder of the debt. On the same day, goods to the value of 369 euro were sold on credit to Barry. This includes 23% VAT and a markup on cost of 20%. So let's look at the first paragraph first of all. So a payment of 900 was received from J. Barry. Where am I going to put that? I'm going to put that into the bank. Now, that is, the bank here is a bank overdraft. 900 euro coming into the bank is going to reduce our overdraft by 900 euro. So minus 900 euro there. Now, then what are we going to say? How much does Barry promise to pay us? Right, so if 900 euro that we received into the bank was 60%, they've promised to pay us the other 40%. So the other 40% is 600 euro. So I put debtors 600 euro there. Okay, so therefore altogether the bad debt recovered was 1,500 euro. So 900 come into the bank and that's minus, it's reduced the overdraft. 600 euro was added to debtors, and overall in total the bad debt recovered 1,500 euro here. So that's the first part done. Now On the same day, goods to the value of €369 were sold on credit to Barry. This includes 23% VAT and a markup on cost of 20%. So, what we're going to do, we're going to take the cost of the stock away from the stock. So 369 is our selling price and a markup. So selling price, which has the markup of 20, okay, and it has VAT on it as well. So what we're going to do to work that out, 369 divided by 123 multiplied by 100 is 300. That is what we sold them for. So Delaney sold them for €300. But that has profit included in it. So what is the cost price then? So €300 divided by 120, which is your cost plus 20%, multiplied by 100, and that is €250 then is the cost price of the goods. So from the stock, we minus €250 there. Now, to our debtors, we add €369. So that is our selling price with the VAT. So they have to pay us the VAT and then we forward it on to the revenue commissioners. Now, what we're going to do then is put the €50 profit into the P&L. So that profit figure is going to be increased because of the 20% markup that we have, which worked out to be €50. And then what we have to also do is record the VAT. Now, sales, why is this plus instead of minus? So see here we minused VAT. Why are we plusing it now? So sales, if you draw a T account for sales, you're going to record sales on the credit side. So you know your double entry rule. So sales goes on the credit side. So therefore, any VAT attached to those sales is also going to be recorded on the credit side. So the VAT is €69. So the VAT in the balance sheet was under liabilities, which is also credit side. So therefore, I'm going to add the 69 there. So overall, my assets are 719 and my liabilities are 719. Okay, moving on to September then. Received 50,000 from the issue of the remaining shares. Now, it's very important that you look back at your balance sheet. So in your finance buy, you'll see that Delaney has 800,000 authorised shares. So you'll see that in your question, 800,000 authorised shares. So if I have 560 at the start of the year sold and another 200, that is 760, I can therefore only sell 40,000 more. Okay, but I've received 50,000, so the other 10,000 must have been the charge when selling them, so share premium there. So that is 50,000 received, 40,000 goes into share capital, 10,000 goes into share premium, and then the bank overdraft is going to be reduced by 50,000 there. So that is 0 and 0 there for September. Next, we have October. So what happened in October? So goods previously sold for 738 by Delaney Ltd were returned. This figure includes VAT at 23% and a markup on cost of 20%. Delaney Ltd issued a credit note for €700 due to a delay in returning these goods. Okay, so we read it again. Goods previously sold for €738 by Delaney Ltd were returned. This figure includes VAT at 23% and a markup on cost of 20%. Delaney Ltd issued a credit note for €700 due to a delay in returning these goods. Okay, right, so let's have a think about it. So what we need to do, first of all, we got goods, Delaney got goods given back to them. Okay, so what we're going to have to do, firstly, we'll record the stock coming back into the business. So how do I find out how much the stock is? Well, add the cost price of the goods returned to stock. So 738 was the selling price and the VAT. Divide that by 123, multiplied by 100%, and that is the selling price. So that's without the VAT. So how do I find the cost of the stock? So €600 divided by 120% multiplied by 100 is the cost price of €500. So I'm going to add €500 into the stock there. Now, there was a credit note of 700 given to the debtors, so we minus 700 from the debtors. Now, if you remember, we had just worked out the selling price was 600, the cost price was 500. So the difference is 100, which is the profit. So that was the 20% markup. Now, instead of reducing the profit by the entire 100, we are going to reduce it by 62. Why is that? Well, the reason is because we charge them €38 for a restocking charge, or sorry, for a late return fee. So it was 738, but we only give them back 700. So that 38 was a late restocking charge. Okay, so we reduced the profit by €62 there. And the VAT is going to be reduced by €138. So that's the amount of the VAT. €138, but why do we minus it? So let's think about this. This is sales returns, and sales returns are recorded on the debit side. So therefore, the VAT related to the sales returns is going to be recorded on the same side, the debit side, and this VAT here from the balance sheet is recorded on the credit side because that's a liability. So we minus the 138 there. So overall, minus 200, minus 200. In November, a creditor who was owed $4,000 by Delaney Ltd accepted equipment, the book value of which was $3,200 in full settlement of the debt. The equipment cost $5,400. Okay, so let's read that again. A creditor who was owed $4,000 by Delaney Ltd accepted equipment, the book value of which was $3,200 in full settlement of the debt. The equipment cost $5,400. Okay, so up in the assets, we'll take $5,400 away from the equipment. So that is the cost price of the equipment. What we're going to do then is add back in the depreciation that has been charged on the equipment to date. Okay, so the book value was $3,200 and it cost $5,400, so the difference was the $2,200. So we add the $2,200 back into the depreciation. Now, the creditor was owed $4,000 and full settlement of the debt, so minus $4,000 here. And so let's have a think about this. At this moment in time, we've got minus $3,200 here and minus $4,000 here. But let's have a look. So a creditor who was owed $4,000 accepted something that was worth $3,200. So the €800 is a difference. So €800 is profit on the trade, okay, or a discount received. Either way, it is P&L balance there. It's going to increase our profit figure for the year, so 800 into the P&L balance. So we've got minus 3,200 and minus 3,200. Now, the last thing that we have to do here is December. So the building's depreciation charge for the year is 2% of book value. The depreciation charge is to be calculated from the date of valuation to and the date of purchase. The total depreciation charge on vehicles for the year is €8,000. Right, so let's look at the buildings first. So we decreased the value of the buildings by 17.1, and we also decreased the profit by 17.1 because when we charge depreciation, that's an expense and it reduces our profit. So how do we get 17.1? Well, at the start of the year, we revalued buildings to 800,000, but we did have land included in that, 110,000. So that's 690,000. Multiply by the 2%, and we had that for the whole year, so that's 13.8. Then in February, you got buildings, they bought an adjoining business that had buildings 180,000. So 180,000 by 2% by 11 of the 12 months was 3,300. So altogether, that is 17.1. So that is your depreciation on buildings sorted. Then the total depreciation charge on vehicles for the year, 8,000. So we minus 8,000 from the depreciation on buildings and minus 8,000 from the profit and loss figure. So overall, you've got minus 25.1 and minus 25.1. So that is your December completed there. And so you have your other December column done. What's left is just to tot up all of your totals as such, and you can see that there are 7 marks going for that, so it could be random where they decide to give the marks to. So that is the 2017 Delaney Ltd 100 mark tabular